Hi, my name is Hillary Sunderland, and I'm Chief Investment Officer at Beacon Wealth Consultants and LightPoint Portfolios. This is your March 2022 market update. It should come as no surprise that Russia's invasion of Ukraine was one of the main worries on Wall Street during the month. As expressed on my last market update, the war has added to already high inflationary pressures. Russia's involvement in the global energy market, base metals, potash fertilizer, and Ukraine's heavy involvement in agricultural commodities such as wheat has only added to global worries about inflation. As you can see from this chart, headline inflation was running hot even prior to Russia's invasion and is now running at one of the fastest paces in decades. And this has led the Federal Reserve, which is the central bank of the United States, to raise interest rates in order to combat inflation. We have received a few questions on how raising interest rates fights inflation, so I want to take a few minutes to walk you through that today. So the Federal Reserve has a few goals, really two. The first is to promote maximum employment, and the second is to keep prices stable, which is another way of saying to keep inflation around 2% annually. And if you've been a long-time client of ours, you may recall that just a few years ago, the worry on Wall Street was that inflation was not high enough because the Fed couldn't seem to hit even the target of 2%. Oh, how we miss those days when we fill up our cars at the gas station today. Well, the Fed's main tool is to battle inflation by using changes in interest rates. The Federal Reserve sets the short-term borrowing rate for commercial banks, and then those banks pass it along to consumers and businesses. The short-term borrowing rate influences everything from interest on credit cards to mortgages and auto loans, which makes borrowing more expensive and saving more appealing. As borrowing to make purchases becomes more expensive, consumers and businesses tap the brakes on spending. They think twice before taking out that loan when it's more costly to do so than before. So, for example, as the interest rates on auto loans increase, consumers may decide that now's not the time to buy that new car. And when there's less demand for the car, the dealers no longer has the leverage to demand higher and higher prices. Rather, the auto dealer accepts what he or she can get. So in effect, raising interest rates decreases demand for goods and services, and with less demand chasing supply, price pressures can ease. Now, it's very important to note that when I say that prices are likely to ease as interest rates adjust higher, that does not mean that prices will return to what they were a year or two ago. That is deflation, which is actually worse for the economy than inflation. The goal of raising interest rates is just to slow the rate of inflation. So prices will continue to increase, but at a slower rate than before. So that's a quick overview of how raising interest rates can help combat inflationary pressures. But one of the things that the market has been wrestling with this year, both in the bond market and in the stock market, is the concern that the Federal Reserve could make a misstep whenever raising rates. To illustrate this, I want you to picture a bowling alley. When you go bowling, you have to roll the ball down the lane in such a way that it spins in order to knock down all of the pins at once so that you can get a strike. And there's little room for error. And if you're anything like me, you often end up rolling the ball right into the gutter. So I wanted to use this as a picture of what the Federal Reserve needs to do here and why the market has been a little anxious as the Fed embarks on this interest rate journey. So as I said before, they have a mandate of maximizing employment and keeping prices stable. So picture the left-hand gutter as the unemployment rate and the right-hand gutter as the rate of inflation. So if they get this wrong and they raise interest rates too slowly in order to keep the economy strong and unemployment low, they can throw a gutter ball to the left. And when this occurs, inflation will take off because there's too much money chasing too few goods. On the other hand, if they raise interest rates too quickly and dampen demand too much, they can throw a gutter ball to the right, and the economy will slow too much and push us into a recession, which will increase the unemployment rate. So as you can see, it's a difficult balancing act. And right now, the market's trying to figure out which way the Fed is likely to lean because they're usually not perfect. They're going to lean one way or the other whenever they go about trying to correct this inflationary problem. So just a few weeks ago, they just released the ball and raised interest rates. And it's going to take some time for higher interest rates to work their way through the economy. So in the meantime, until we see what effect this has on the economy, you should expect to see some volatility both in the bond market and the stock market. It's also important to note that as a consumer, you should expect to continue to pay higher prices at the pump, higher prices at the grocery store, and higher interest rates on loans for at least a few months before you'll start to see any improvements on the inflation front. So what does this mean for me as an investor? Well, here is a picture of the yield curve for Treasury bonds, which are US-backed government bonds. And just to note, the further you go out on the right, the longer the maturity of the bonds. What I want you to zone in on here is the purple line, which is the date that the 10-year Treasury hit a record low, which occurred in August of 2020. Compare that line to where we are trading today, which is a dark blue line. And you can see that bond yields are up considerably over the last 18 months. Quite a bit of this move has come over the last few weeks, especially in the shorter maturities. Now, this is important because when interest rates rise, the market value of already adjusted bonds falls in order to compete with the new bonds that are being issued at higher interest rates. So bond prices fall as yields rise, and this has resulted in the normally dull bond market experiencing some of its worst losses in years during the first quarter of this year. Let's take a look at the performance of some of the major bond asset classes year to date. Starting from the left there, the Barclays U.S. Aggregate Bond Index, which is a measure of the performance of domestic investment grade bonds, was down 5.93% for the quarter. The Global Bond Index was down a bit more, off 6.16%. Emerging market bonds, which were hit with the invasion of Ukraine by Russia for sure, was down 10.02%. Even inflation-protected bonds, given their interest rate risk, suffered losses on the quarter, with TIPS index down a little over 3%, and high-yield bonds were down 4.51%. So broad losses across your major fixed income asset classes for the quarter. Let's look quickly at the equity side of the equation. Similar to the bond market, investors in equity markets had few places to hide. Viewed as a whole and leaving out commodities, which soared, the new year has been a futile one for investors seeking shelter from market declines. The S&P 500 suffered a peak-to-trough decline of 13% at its worst, while the tech-heavy NASDAQ, not shown here, but widely followed in the media, as well as the Russell 2000, which measures the performance of small-cap stocks, declined about 20%. Before these rebound in the last 2 weeks of the year. So given growing optimism that stocks may serve as a hedge against inflation, the market bounced back in the latter half of March, and it generally outperformed bonds. The S&P 500, which is a measure of the performance of domestic large cap stocks, ended the quarter down 4.6%. Smaller companies, as measured by the Russell 2000, ended the quarter down 7.53%. International developed market stocks were pressured by inflation and the war of Ukraine and ended down 5.91, while emerging markets were down a little more than that, off 6.97%. As you can see here, the only major asset class that performed well for the quarter was commodities, which we do have exposure to through a managed futures fund within our strategy. So overall, it's been a difficult start to the year for investors, especially given that we are coming off of 2 years of nice returns for both the stock and bond markets. And while we've started to see a rebound in the equity markets, the repricing in the bond market over the last few weeks can be unsettling to more conservative investors, given that the bond market is usually quite dull when it comes to returns. So I wanted to leave you with two things. First, it's important to note that we are active managers, and we already positioned portfolios for a rise in interest rates months ago. I'm happy to report that all of our fixed income funds outperformed their respective benchmarks for the quarter. And we are taking on less interest rate risk than the benchmarks that I showed you just a few slides ago. And we have been underweight fixed income investments in our portfolios in order to help hedge a rise in interest rates. So we've done a lot on this side to help protect our clients from rising rates. But if you have any specific concerns about your individual portfolio, we'd be happy to discuss your particular situation in more detail. And second, it's important to note that despite concerns to the contrary, a rising interest rate environment does not preclude positive returns from fixed income portfolios. While rising interest rates initially cause bond values to decrease, eventually the declines will be offset as bonds mature and can be reinvested at higher yields. If you have a longer term time horizon, which includes most people in their retirement years, there's a silver lining here. if you just exercise patience and allow the bond market some time to recover. This is short-term pain for longer-term gain. As always, we thank you for your continued confidence, and please reach out to us with any questions that you may have.